Lucid Group Inc. is trading at $5.73 right now in intraday market action, marking a slight positive tick of 0.17% on the day. While a casual glance at that minor movement might suggest a quiet, stable session for the electric vehicle manufacturer, the underlying structural changes tell a completely different story. Most retail market participants are looking at this $5.73 price tag and treating it like a typical beaten-down tech stock waiting for a macro turnaround. But the reality that nobody is discussing is the massive divergence between current institutional positions and retail expectations. While the crowd thinks the stock is just resting in a sideways consolidation pattern, a deep dive into recent institutional flow shows that a massive restructuring of equity is happening behind the scenes, largely driven by its primary sovereign backer. The expectation is that this company will effortlessly scale its production lines because it has an endless line of credit. But the reality hitting the factory floor is a messy web of supply chain disruptions and unexpected legal headwinds that are forcing the market to completely reprice the asset. When people talk about the electric vehicle sector, their minds immediately jump to big names like Tesla stock or legacy players attempting to pivot. The general consensus surrounding Lucid Grouping is that it represents the absolute pinnacle of luxury electric engineering, boasting unmatched range and efficiency metrics that should logically guarantee long-term market capture. Retail investors look at the engineering pedigree, the beautiful design language of their flagship sedan, and the backing of the Saudi Arabian Public Investment Fund, concluding that it is only a matter of time before the stock breaks out of its single-digit slump. This widespread belief creates a floor of hope, but when you look beneath the surface, you find a reality that is far more complicated and punishing than the popular narrative suggests. The engineering is outstanding, yes, but the operational execution is struggling against severe gravity. Recent disclosures have forced a painful realization upon the market, highlighting that having the best battery technology in the world does not matter if you cannot physically deliver vehicles to customers efficiently. Looking closely at the recent stock movement, the daily trading volumes reveal a massive battleground between short sellers and institutional accumulation. Over the past few weeks, trading volume has hovered around 18 million shares daily, showing a high level of churn that points to deep institutional disagreement. The stock has been trapped in a brutal 52-week range, dropping significantly from its relative highs to a low of $5.55 before finding this temporary stabilization around the $5.73 mark. This stabilization is highly deceptive. Just a few weeks ago, a massive bombshell dropped when the company filed a current report outlining preliminary financial results for the first quarter of 2026. The market expected revenue to land somewhere near $358 million, with some optimistic Wall Street models pushing toward $433 million. Instead, the reality was a staggering miss, with revenue crawling in between $280 million and $284 million. Operating losses for the single quarter exploded to an eye-watering range between $985 million and $1.005 billion. This financial miss triggered an immediate and severe chain reaction across major online investing platforms. The moment those figures went public, institutional panic set in, leading to a sharp intraday drop. To make matters more complicated for anyone participating in self-investing or managing an individual brokerage account, the company simultaneously announced a massive capital raise of $1.05 billion. This capital injection included a $300 million public stock offering, a move that heavily dilutes current shareholders. For retail traders using popular investing sites or tracking their portfolios on the Robinhood app, this dilution felt like a punch to the gut, dropping the stock instantly. When you see a company consistently burning through nearly $1 billion a quarter while diluted share counts rise, the bullish narrative around long-term valuation begins to fracture under macroeconomic pressures. High interest rates are making luxury vehicle financing incredibly expensive, which directly dampens consumer demand for vehicles priced at well north of $70,000. Compounding these steep financial losses is a fresh layer of legal risk that is beginning to heavily weigh down sector momentum. Just this week, multiple global investor rights law firms announced class action lawsuits against the company on behalf of shareholders who acquired securities between late February and mid-April of 2026. The core of these legal allegations hits exactly at the intersection of expectation and reality. The lawsuits allege that the executive team actively misled the public by failing to disclose critical supplier quality issues that severely disrupted the deliveries of their highly anticipated luxury SUV model. While management was publicly boasting about enhancements to their manufacturing capabilities, the reality on the ground was a logjam of undelivered vehicles and disrupted assembly lines. When the truth of these supplier bottlenecks finally leaked alongside the disappointing preliminary revenue figures, the market reacted with aggressive selling pressure. Comment below how many shares of Lucid Group Inc. you currently hold in your portfolio right now, or if you are avoiding the luxury electric vehicle sector entirely. This intersection of supply chain failures and missing financial targets is exactly why the asset is experiencing such wild intraday volatility. If you look at how this stock is treated across different platforms, you notice a massive divide in strategy. For example, risk-averse investors relying on automated asset allocation through services like Schwab Intelligent Portfolios are seeing their exposure to these speculative EV plays automatically reduced as volatility metrics spike.
Meanwhile, active traders utilizing advanced execution tools on the Interactive Brokers platform are heavily shorting the stock or using options to trade the massive daily swings. The Interactive Brokers trading desk has seen a substantial increase in BARMA fees for the stock, indicating that short sellers are aggressively betting on further downside, despite the price already sitting in the $5 range. This heavy short interest creates a coiled spring effect, where any piece of positive regulatory news or an unexpected production update could trigger a massive temporary short squeeze, confusing retail investors who do not track institutional flow. To truly understand why the stock is behaving this way, we have to look at the underlying business model and how it contrasts with the broader industry. The company operates as a vertically integrated luxury automotive technician, designing and manufacturing advanced electric vehicle powertrain systems and complete battery packs entirely in-house. Founded originally in 2007 under a different name focused on battery technology, the firm pivoted to vehicle manufacturing under elite engineering leadership, aiming to beat the driving range of every competitor on the market. Their flagship luxury sedan achieved historical EPA-rated ranges of over 500 miles on a single charge, a feat that legacy automakers still cannot match. They sell these premium vehicles directly to consumers through an independent retail sales network and direct online investing portals, bypassing the traditional dealership model entirely to preserve margin. However, manufacturing an elite vehicle prototype is infinitely easier than scaling a global mass production line. The company started building its primary sedan at a specialized facility in Casa Grande, Arizona, but early production output consistently missed internal targets due to logistics bottlenecks. While they managed to produce over 8,000 vehicles in 2023 and slowly ticked up their numbers through 2024, the capital required to sustain operations has been astronomical. This persistent cash burn is why the business is completely dependent on its parent organization, the Public Investment Fund of Saudi Arabia, which holds a massive majority stake of over 58%. This sovereign wealth backing is a double-edged sword for individual brokerage accounts. On one hand, it provides an unparalleled safety net that prevents bankruptcy. On the other hand, it means retail investors have zero voting power, and the sovereign fund can continuously structure capital raises that dilute public shareholders to keep the lights on in Arizona and their secondary assembly plants overseas. When you look at the major institutional holders tracking this asset on specialized investing sites, you find a massive presence of passive index funds. Giants like Vanguard, BlackRock, and State Street hold millions of shares purely because the stock is a component of the Russell 1000 index. This means a substantial portion of the daily trading volume is completely disconnected from the actual business performance. It's just automated inflows and outflows driven by broader market indices. For individual retail investors engaging in online investing through platforms like SoFi Invest or using the Fidelity mobile app, this creates a highly confusing environment. The stock will randomly pump or dump based on macroeconomic liquidity shifts rather than actual vehicle delivery data. This brings us directly to the future outlook and the critical catalysts that will determine whether this company survives as a major automotive player or remains a highly speculative trading instrument. The central narrative supporting the stock right now is the rollout of their second major model, a luxury SUV designed to capture a much larger share of the premium family vehicle market. If the company can successfully resolve the current supplier quality issues that triggered the recent class action lawsuits, SUV deliveries could provide a massive revenue surge in the latter half of 2026. This potential recovery is what active traders on the SoFi trading platform and Fidelity trading platform are closely watching. If production reality matches the bullish expectations, the company could easily beat its lowered guidance, sending the stock back into double-digit territory. However, the downside risks are incredibly steep. If the operational losses continue to hover around $1 billion per quarter, the company will be forced to execute another massive capital raise by early next year, further crushing the equity value of retail accounts. Furthermore, the competitive landscape is becoming brutal. High-end luxury buyers are no longer fighting for limited EV options. They now have access to premium electric offerings from legacy German and domestic manufacturers, who already possess established global dealership networks and mature supply chains. The company's lack of a physical service footprint in many regions remains a major deterrent for everyday consumers, directly impacting order cancellation rates. Looking back at how expectations have constantly battled reality for this stock, the lesson is remarkably clear. The market initially valued this company as a hyper-growth tech disruptor capable of unseating the dominant players in the industry. The reality has revealed an incredibly capital-intensive automotive manufacturer that is learning just how painful global manufacturing logistics can be. The sovereign wealth backing ensures the company will not disappear overnight, but it does not protect public retail investors from massive equity dilution. As we watch the intraday action hold around $5.73, the stock remains a high-stakes battleground where short-term technical indicators are fighting against structural operational struggles. Investors looking at this through a long-term lens must look past the incredible range metrics and focus entirely on execution, production margins, and whether the company can finally build a vehicle without burning through its entire balance sheet. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.